Greetings. This is going to be a monthly update on the home construction data, which is one of the major economic events that's occurring in the United States right now. And the seeds for another real estate bust cycle have already been sown. The Federal Reserve has no idea how to avoid creating the same problem that it created before, because the most obvious solution, which is to send cash directly to people rather than fiddle around with interest rates and buying up the mortgage market, is something that doesn't occur to them because they think that maybe someday there might be a small amount of inflation, and they have a very memorized answer about why a small amount of inflation will be bad, and have never been asked why they don't think deflation is bad. But over construction of houses can certainly cause deflation, and probably will, which will require more money printing and will finally force these egghead economists to print money in a manner that sends cash directly to people. But I think a politician will have to arm twist them into doing that, because they will never arrive at this conclusion of their own accord. So if we go to what is the Atom publication over here, Chapter 6, Current Government Policy Will Soon Be Ineffective, there's a section in this called The U.S. is in a Real Estate Trap. And I want to highlight just one section in there, this paragraph. I'm going to read this paragraph. In the meantime, the Federal Reserve, in lowering mortgage rates through the purchase of long-term treasuries and mortgage-backed securities, MBSs, is specifically seeking to inflate just one type of asset class and hope that buoys the entire economy. The problem is, any action that increases home prices simultaneously triggers the construction of new homes, thus increasing supply. Hence, any government action to boost home prices is like trying to fill a sieve with water. Read that and see what it means. I wrote this in 2016, and now we're in the same situation again. The low interest rates and money printing that the Federal Reserve does are necessary, as I explained throughout this channel, but by distorting the bond market and hence the mortgage market, they're concentrating overinvestment in one sector, whereas if they just sent cash directly to people in equal amounts, you would get a much more smoother and diffuse and free market dissemination of the liquidity and the monetary creation to offset this technological deflation. And that's why every month we look at whether home price construction is still making new all-time highs. So we go to that data. Construction spending in August. Click directly on this chart. The same three color codes that we have seen in earlier editions of this video series from prior months. Red is residential, orange is public government, and blue is non-residential, private commercial property. This includes retail space and office space. And as we know from other videos on this channel, the wholesale destruction of demand for retail real estate is very well documented, as I speak about in this video over here. But the COVID-19 crisis and the resultant telework revolution has also demolished demand for office real estate, which I speak about in this video over here. And therefore, the only type of real estate that is still in demand is housing, residential construction. Now, when the Federal Reserve makes interest rates low and buys up mortgage-backed securities through the quantitative easing program, that creates a climate in which home prices can rise. And while, yes, the central banks of the world should be printing more money and should be doing it exponentially, they should be sending cash directly to people instead of distorting just one or two sectors of the economy and making sure none of the printing that they do goes to any other sector at all. So you see housing prices reaching all-time highs, whereas the other 85 or 90% of the population is not benefiting from this printed money to nearly the same degree. Maybe their home price is going up, but what if they don't own a house? And what if they work in a service job that has been demolished because face-to-face jobs have already gone away? They're not benefiting, and therefore from the Federal Reserve action, you see residential construction reaching this all-time high. Now this is a nominal all-time high, therefore it's still a smaller percentage of the total economy than the prior peak in 2007, but this peak was so large that it caused the deepest recession of the last 75 years, and it took several years to even recover from that recession, 6 or 7 years at least, depending how you look at it. And now we're at a higher dollar peak than before. This is huge, and this is going to cause the same type of situation again, because if this dollar amount stays above even 700 billion, right now it's almost 800 billion, but if it stays above 700 billion for just another year, the amount of new supply of housing that will be created is again going to cause a housing glut. And that causes another housing bust, which will lead to another recession for which they will have to do more money printing, but they will not be able to prop up the housing market forever. more and more of that printed money is going to leak out into other sectors, and they will be forced into the ultimate outcome that I've been recommending, but they can avoid a lot of human suffering, the human suffering of millions of people, in fact, if they just went to that type of solution more directly, sending the printed money directly to people and simultaneously lowering income tax rates. But now we have housing at this type of a peak, which again is just going to cause a huge oversupply because, as we saw earlier in this video, anything that props up home prices also stimulates the construction of new homes. So what is the percentage year-over-year growth rate? So for that, we go back to the original article and then to this chart over here. In the 2004 through 7 period, it was above 20% a year for 2 years straight. Now, we were above 30% a year for a short time, admittedly, but still 30% a year. And now it's drifting down a little bit because the year-over-year growth rate can't stay that high. But as I said, if it's above 700 billion even a year from now, even though this will have dipped negative, it would not have corrected down to a lower growth rate quickly enough. And the situation of oversupply is already baked into the cake, so to speak. Plus, now that we are in the telework revolution, the bust will take a very different form. It is in fact the expensive cities that will see the most severe reduction in prices, and the cheaper outskirt areas that will have more of a cushion because a lot of workers who will be able to still do their jobs over Zoom or some other video conferencing medium will simply move to where housing prices are 1/20th as much. The story of the prior housing bust was that places like the suburbs of Phoenix and Las Vegas corrected hugely and didn't get back to their old price, even without adjusting for inflation, didn't get back to their old price until 10, 11 years later, whereas by that time Palo Alto or San Francisco was 3 times higher than its 2007 price. I believe now the situation will be reversed because telework technologies such as Zoom, are in fact more of a smoothing mechanism. The distortions caused by there being too much housing in one place and too little in another somewhat mitigate, not entirely, but somewhat get smoothed out because of the ability to do telework and the ability for people to get new jobs in cities that they never have to relocate to. That's already happening. It's not about people moving away from their existing jobs as much as companies hiring new people who never lived in the city of the headquarters office in the first place, and visit there from time to time, but never actually move there in the first place. So this is already being baked in the cake, even if this red line gets down to 0, because the blue and orange lines are never going to grow that much anymore. We are in permanent oversupply of both retail real estate as well as office building real estate, as I've explained many times. The only way for the construction industry to still grow is through creating more housing. Now, one commenter pointed out a few weeks ago that, well, the cost of producing new housing may have risen a fair bit, therefore, despite the high dollar amount of new construction, the increase in new unit supply may not be that much. That could be true to a small degree, but I don't think unit production price has increased 100% in the last 7 or 8 years. But even if it's increased somewhat, well, you know what that means. That means housing construction has become expensive and is more vulnerable itself to technological disruption. Basic housing is a commodity product. There's nothing magical about it. And if its construction cost has risen hugely when the manufacturing cost of almost every other consumer good has gone down a lot, you are going to get technology companies that can create houses at a much lower cost and much greater speed, whether through modular construction, 3D printing, and things like that. I'll talk about that in another video. But ultimately, this situation is quite cornered. So unless there's a soft landing in the form of housing construction going down below $700 billion a year on an annualized basis within 12 months, there's going to be a sharper correction, especially since the theoreticians, the eggheads as I call them, of the Federal Reserve, talking about tapering and raising interest rates for which they have no justification because there's no aberrant inflation. They are going to tank this market to a much sharper degree than otherwise would happen in a soft landing scenario. So that is also something to think about. Remember, ultimately housing is a commodity. In the United States, a single family house is really just a wooden box. The materials do deteriorate over time. There's nothing inherently return generating about it other than the scarcity of its supply. It is not like the share of a tech company where the product continues to improve over time due to atom principles and technological exponential trends. a house is just a wooden box, and you can expect the actual structure to deteriorate over time, just like your car might deteriorate over time. The price goes up only because of the scarcity of supply of those houses, not the scarcity of land. There's plenty of land. If there was not plenty of land, you would not have these zoning tax restrictions, which I in fact talk about in this video over here. The zoning tax is in fact a bubble creating situation that will cause certain cities to experience catastrophic downward shifts in their housing prices under almost any scenario of technological disruption that appears to be getting closer by the day. So this is certainly some food for thought, and if you like this type of content, I encourage you to subscribe to this channel. Thank you very much for watching.